Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and in investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this program on whatever platform you happen to be using. Well, the Fed meets next week, and the consensus is that a rate cut is coming. How will the markets react, and what should you do with your portfolio? My panelists have their opinions. Also, talk of new corporate bond offerings this month and a $1 trillion pay package for a CEO. It's coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Frank Rossetti of HF Management Company. Kim Forrest of Boca Capital Partners is also with us. Michael Godwin of Fergasso Financial Advisors. And there's one more spot at the table, and it's occupied by Kristen Hemmings of Coghill Investment Strategies. Kristen, thanks for joining us for the first time ever on The Bull, the Bear, and You. I will warn you that the people you're on with are just vicious. They will just tear you apart if you say the wrong thing.
I'm a long-time listener, first-time participant, so looking forward to it.
I didn't know we were doing a call-in show now. That's great. Since the last time we met, the markets have been basically moving higher with the new all-time closing high set by the Dow and the S&P 500. And the Russell 2000 continues its upward slant. But we are now in the month of September, and I only checked the last 10 years, but over the last 10 years, the markets have ended this month lower than they began 60% of the time. So what will happen this September? No one knows at this moment, but we might have a few clues. The first one is the Fed meeting is set for next week, and the consensus right now is that the Fed will reduce its key interest rate because of weak numbers on new job hirings. So I have several questions related to all of this, and I'll begin with this, and I pose it to Michael. Has the market already baked in any interest rate cuts? In other words, if the Fed next week comes out and says we're lowering at 0.25%, can we expect any reaction at all?
So I think no matter what they do, you'll see a reaction, even if it's a cut. They've baked in, the market is pricing in, Stacy, more than a 100% chance of a rate cut coming up. How can you get more than 100% chance? Well, the market is now expecting a slight probability that there could be 2 rate cuts, meaning 50 basis points in cuts as opposed to 25 basis points. So it is essentially, the market thinks it's a done deal that the Fed will cut rates at the next meeting. I do expect to see some movement, even if they cut rates, that the markets could rally a little bit. But certainly, if in the off chance that they do not cut rates, you'll definitely see market movement likely to the downside in that scenario. I mean, economic data is starting to really, really soften quite a bit, and you likely see market movement if they don't. But I think it's a pretty much done deal that they'll cut rates.
All right. When you say 2 rate cuts, you mean at one time a 50-point basis
Correct.
cut? Okay, just
Correct.
One in September like that.
1 rate cut is 25 basis points. If they do 2 rate cuts, it's 50 bips at the same time.
Okay, and the same after the same meeting next week. So, Kristen, I'll let you come in next. What do you have to say?
Yeah, so I think that it is pretty, based on how cautious the Fed has been so far this year and really watching inflation closely, and we don't even have all the tariff data baked in yet, I think it would be surprising if they did 50 basis points all at one time. And I think the market's really watching to see, is this just kind of a standalone rate cut? Let's keep watching the data. Or are we starting a rate cutting cycle? That's, I think, has not been baked in yet. I think pretty certain it's going to come down in the weeks, but we have 2 more meetings after this before the end of the year. And I think that there's still a lot of unknowns there.
If you remember, last year they cut rates by, I think it was 50 basis points at this time, or maybe it was in October. Is there a meeting in October? It all runs together. It was right before the election. So, I think that was a long anticipated one last year. This also is long anticipated. I agree that the market's going to react, but I don't really care about the day of. I want to know what's going to happen for the rest of September. Now, I think we should all understand that rate cuts are important for a couple of reasons. I think 2 primary reasons would drive the market. One is that the rate at which we discount our cash flows, this is getting very nerdy, but that is important, and the 10-year should come down if we have a rate cut. Should we'll see. There's a lot of factors that drive the rest of the rate curve. But the second important reason is just the fact that we need to have housing start up. And if this can affect, this rate cut can drive mortgage rates, it could create a virtuous cycle of hiring, of lots of goods being purchased, and just, a revamp of the consumer economy, which, it's been missing for years now, the home buying cycle. So I think those two things are things that could drive the market higher.
Okay. Frank?
If you think about it, the bond market is reacting as if rates are going to start going down. My concern, however, is that the Fed has a mandate to keep inflation under control as well. So we have conflicting things going on here, and this time, because of that conflict, I suspect the 50 basis point drop later this week is probably optimistic. A second drop, we'll wait and see. We're going to see inflation numbers later in the week. They're expected to be up a little. If that turns out to be accurate, then I think that you might see the Fed pay even more attention to the employment numbers, which are also conflicting. I mean, we've got pretty much full employment, but we aren't adding new jobs. But the volume of the number of people available to work is shrinking. So, I mean, it's a pretty strange time right now from a historical perspective to try to figure out what's going to happen next.
All right, you brought it up. I was going to pose this question, and that is that what if that inflation number is much higher later this week? Would that delay a possible rate cut?
It depends on your definition of much higher.
Okay.
If inflation comes in a little bit higher, I don't think that's going to slow down the rate cut. The Fed, we talked about this before, and Frank brought it up. The Fed has two mandates: one, maintaining full employment, and then two, price stability. And their definition of that is 2% price increases year over year over time. They care much more about the former than the latter. They care much more about the employment situation. I think we're going to hit a rough patch in terms of employment, and Frank kind of brought that up a little bit. Unemployment ticked up a little bit to 4.3% from 4.2, very, very small, but job growth is anemic at best. And these numbers continue to get revised down month over month once more data comes in. And I think that's going to be a problem for the economy. And I actually think it's going to be a problem for the markets as we head into the back half of the year.
All right.
Also, from an inflation perspective, Stacy, 3% inflation is not high historically. The average rate of inflation, depending on whose numbers you look at, over the last 20, 30, 100 years is 3.5 to 4%. So 3% is not a frightening number. They've set this 2% mandate. I don't know where that number came from, never did. And that's a pretty low bar to hit. And I don't know if we'll ever get that low without a recession.
All right, well, that's well and good, but the way the markets react right now, they do think that anything higher than the 3% is not good.
Well, I think the Fed has really stepped up, and it was at least pointing to the direction that inflation is kind of coming off of being the front burner sort of topic for it at Jackson Hole. It feels like a lifetime away, like 3 weeks ago. Oh my goodness. It was all this hubbub about language was changing, coming from the Fed that indicated it was more concerned about the job market. And I think that they need more than 3 weeks to kind of flip back the other way to, get job number one being, jobs, and putting that to the back burner over inflation. Both of these hit consumers, right? Consumers are mostly job holders, and they're mostly, everybody buys stuff. So the Fed is trying to walk that line, and it's a hard line to walk.
I also think that the job numbers could be artificially low a little bit. I mean, growth is definitely slowing, but if you're running a company right now and you're not sure about your import costs, the logical thing to do is to not invest in growth or to not hire until you figure out what all of your costs are. So part of this too has just been the lack of visibility that we've had this year in seeing what's coming down the road with tariffs. And so not that I don't think it would be this robust job market if it weren't for that, but that's definitely not helping.
All right. Well, that's Kristen. You just spoke. I'll stay with you for this. What about your clients, or those with a 401k or an IRA? Would a rate cut, or even maybe the Fed deciding not to do anything, make much difference to your clients' portfolios?
You know, the Fed deciding not to do anything, I believe, would bring volatility just in the decision-making process, and we would see, you know, markets kind of pull back from there. But for the average investor, if you are managing your own 401k or how we're working with our clients, it's better to have a methodology for when are you rebalancing, and not if you're waiting for these Fed meetings to be making decisions on how you're investing your portfolio, you're sort of too late. You need to have another way of approaching. So with our clients, we're really looking at, does your overall allocation match with your risk tolerance, your need for cash flows, your long-term goals, and then we rebalance when it makes sense to do so. So if you're managing your own 401k and you haven't rebalanced so far this year, might be a good time to do that. If you're an investor that has been sitting on cash waiting for the right opportunity, there might be some good days ahead to put some of that money to work. But we don't encourage people to wait for these data points to be making decisions on how they're approaching their overall portfolio investment strategy.
Yeah, that's perfect advice. I mean, our industry is full of cliches, and I can't stand any of them, but they're all pretty valid. Whether diversify, stay the course, rebalance here. I mean, it makes sense. I mean, right now, again, I think I'm slowly turning the corner, Stacy. I'm becoming a little bit more cautious on the markets right now. So, in my opinion, the equity markets have done very, very well. Even most of the bond markets outside of munis have done well for this year, but this is a really good time to rebalance back to your targeted allocation. Even maybe going a slight underweight to equities won't really disrupt the overall balance of your portfolio longer term. I'm always a big fan of never making wholesale changes to the portfolios, but tweaking it at the margins can make sense based on your economic views going forward.
Can you explain a little bit more, Michael, what you mean about being cautious? You did a little bit there about how to do it, but can you delve into that a little bit more for me?
Why I'm a little bit I
Well,
think
no, not necessarily why, but how you approach being cautious with a portfolio.
Yeah, I mean, again, you have your set allocation, and your allocations for the longest time it's been, equities and bonds, right? 60% equities, 40% bonds, whatever that allocation is based on your risk tolerance. We now have alternatives in our portfolio, but I'll leave that out for now. So if you're a 60-40 portfolio, which is sort of an average-ish investor, 60% equities, 40% bonds, if you want, over the past year or so, that allocation's probably drifted a little bit because equities have done a lot better than bonds. So you might have gotten up to a 65-35 portfolio simply because equities have done better. So all you need to do in that situation is trim while it's good, right? Bring your equities down because they've done well to get back to a 60-40. Or if you wanted to, take it a little bit underweight, 55-45 or 57, 57% equities and the rest into bonds. Just maybe a slight underweight to your targeted equity allocation position would be fine.
All right. So, Kim, what's your reaction to the possibility that Michael's going to be a little bit more cautious here? Are you going to be more cautious?
No, she's not. I'll answer that for you, Stacey.
No, I'm recoiling from that, but that's not my role in this whole thing.
I know.
Yeah. No,
Well,
I
guess my basic question would be then, Michael says, equities have run a really great course right now. Maybe it's time to be a little bit more cautious about going into equities, and that's your, in your wheelhouse as far as which stocks to be taking a look at.
And there we have it, Stacy. We got to it. So in my world, I believe there's some sector or some group of stocks that are on sale right now with respect to what we think they can do in the future. And right now, AI is on the boil. The pot is bubbling over. We expect, there's some crazy ideas out there. And, we expect that in the next 2 years, we'll never have to work again. We have some crazy, it's not true. because of AI. I'm playing this up, but I have seen articles from normal pundits that are actually thinking we're going to have this widespread AI-caused unemployment. Don't believe it. So what I'm looking at is taking some of those gains from the AI area and then deploying them in other areas. I've already talked about probably my favorite thing, which is housing. We hear complaints about housing, not enough. People want to buy, too high prices, mortgage rates are too high, blah, blah, blah. Well, if we have a declining interest rate environment, and this is the big F, we still have jobs, which I believe we will, that is going to open the door, the literal door, to home buying and all that it brings. So I am shifting internally my strategy to be more about bricks and mortar than Databricks, we'll just say. And that's a hot company right now, Databricks. So.
All right, you said that you look for companies that are quote unquote on sale. Is there like a blue plate special on, a blue light special in aisle 10?
To me, yes. I mean, I look at some areas that have been unloved and overlooked. And that's where I would begin. Now, I'm going to throw out a cautionary area that people should not necessarily go fishing in, and that is healthcare. Healthcare right now is in a state of turmoil. 50% of every dollar that gets spent is from the government. The government is rethinking the way it wants to do healthcare. So danger, Will Robinson. Danger, stay away, because you don't really know what a bargain is until the government decides how it's going to pay, reimbursement rates.
Frank, you used to handle people's portfolios. You're now into alternative investments, but if you can wrap this segment up for me, that would be great.
I can remember back in the 70s when the market was very high and the Nifty 50 were a big deal. And there's a couple people here probably weren't born then when I was started in my career in 1971. But John Templeton got a lot of flack because he had 20 or 30 or 40% of his portfolio in cash. Today, people are looking askew at Warren Buffett, who is the current version of John Templeton, because about 50% of his money, forget the leverage, of the actual assets that he has are in cash. And the reason is he can't find anything to buy. Now, like Kim, those people bought stocks, they played the equity markets, that's what they did. They're unlike Kristen and Mike here, who do allocations for people and can tweak the allocations a little bit. They just own equities. So if you look at then and now, you're seeing a time where finding, what were those words you used, Kim? Unloved
areas of the market
are hard to find. And what's going to be the catalyst to get them moving? So personally, I think that being cautious makes a lot of sense. And you can own equities and be cautious. Focus on dividends. Focus on businesses that are kind of necessary. And go from there and lower your expectations, because I don't think getting the 10 and 20% people think they're going to get in the stock market is a realistic expectation.
What is a good expectation right now?
Oh, your guess is as good as mine, but I would say 5.
Okay. Anybody disagree with that? All right, Ken?
You're at a point, Stacy. I mean, stocks are valued. Stocks can go up or down in two ways. One is with the earnings of the companies go up, and the other one is that the price that people are willing to pay go up as well. So earnings, I think, can continue to do pretty well, as Kim mentioned. Analysts expect better than 10% earnings growth next year, which all else equal, you would expect stocks to go up 10%. The problem is they're relatively richly valued right now. So if you get a little bit of multiple compression, that's going to weigh on those earnings. So somewhere between 5 and 10%, I think, is fine for a best guess for next year, in my opinion.
Okay.
And I agree with that calculation, Michael, but we forget we might be in a declining interest rate environment, which always causes you to expand the price to earnings ratio. So valuations I know this is sickening, could go higher. But again, remember, most of our markets have been driven by those crazy kids at the Magnificent Seven, mostly NVIDIA. So I think if you look at it on a market basis, you are overlooking at, or AI is driving more than it should in the market. So those are kind of the mechanics that I see. I hope I'm explaining this well. I see the pictures in my head from a mathematician's point of view, and hopefully I'm getting them across. Now, and this is a caveat, like don't, be cautious, have a risk tolerance, do all that kind of stuff. But these are the reasons why I believe we can continue to see higher than 10% market movements in the next years.
All right. I read that a moment ago I said about the month of September in equities markets, basically. So I also read that it's not uncommon for companies to make new bond offerings in September. So, Frank, as an investor, are these new corporate bond offerings that are coming out, especially from major corporations, something that an investor should be looking at?
Well, when you talk about rates of return and what you need to earn and risk-reward relationships, how much risk you're taking and how much reward you can expect to get. I personally think on the longer term, and I don't mean longer term bonds, but it applies to that probably more so, the risk you're taking, you're not getting rewarded for the risk you're taking. You've got credit risk. The U.S. government is in question today. I don't believe it needs to be, but it is. And the credit risk you're taking. You have inflation risk. We're running a 3% inflation rate, which means if you get 4% and pay tax on it of 25%, you're getting a zero rate of real return after taxes. And I think that the risk-reward relationship in bonds is awful. So I think that unless you're forced by some investment policy statement, like pension plans are, that you have to own these things, all right, I don't think regular people should look there. There's other ways to get income. You can look at preferred stocks. You can look at municipals. At least you're not paying the taxes. If you're in a high enough tax bracket, they make sense. You can look at alternative asset classes, certain alternative asset classes that offer a reasonably secure yield. There are ways to do this. Right now, the international markets, and be careful there, but in the international markets, you can get higher yields that might make the risk worth taking. And there, I wouldn't buy individual bonds. I would only use a manager for that. It's too difficult to ferret out which company's numbers are actually real, and from my perspective. So I look at the bond market as a dangerous place to be. Although on the short term, for the next few weeks or months, when interest rates are dropping, you can probably make a quick capital gain if you can sell them. And they're difficult to sell if you own individual bonds. So if you're in ETFs or mutual funds, it's a little easier to transact.
Well, Frank's right. We agree that not all corporate bonds are created equal, and it is really important, especially if you're owning individual bonds, to understand duration, to understand the interest rate environment and the risks there, the sector, all of that, which for the average investor is hard to do. Also, the credit rating is really important because even if interest rates come down, they're still high, and companies are refinancing at these higher levels. So that's where it could make sense to use a mutual fund that has a portfolio manager that's helping choose what bonds you're using, just so that there is someone in the space that understands it a little bit better than cherry picking individual bonds. But to your point, Stacy, this is a busier month in bond issuance. It's like everyone's back from summer vacation. Investors have liquidity they're looking to spend. Companies are trying to figure out their financing as they go into the coming year, so that there is more activity in September generally.
I think the only pushback I'd have on Frank's comment in terms of there's other ways to get income and yield is he's not wrong, but when you look at the bond side of the portfolio or that side of the portfolio, it's not just about your return and income. It's about finding something that is going to be a diversifier or a co-varying asset to get the equity portion of the portfolio. Because to be perfectly honest and candid, over the long haul, equities are almost likely always going to outperform bonds. So one of the only reasons you hold bonds is I need to protect against my equity portion should the equity market still off 15, 20%. Yeah, it's great to get an extra 5% or so in income that Frank mentioned. If you can do it tax free through meetings, wonderful as well. But making sure that it's a bond or a fixed income asset that not only can generate income but can also at least be the ballast in the portfolio should the equity market sell off is, I think, of the utmost importance, particularly at a time like today when equity market valuations, although Kim says they can continue to go up, but they are pretty richly valued.
Okay. It's being called the $1 trillion man. The board of Tesla is asking the company's shareholders to approve a 10-year compensation package for Elon Musk that amounts to $1 trillion. There are a lot of goals that he would have to reach to be compensated so richly, but it does raise the question once again about CEO salaries and compensation. So, Kim, how important, because you always talk about it, the importance of who the CEO is of a company, how important is it that your company, that your analysis of whether to buy a stock in a company is based on the CEO?
I think in a case like this, it's extremely important, and because they're willing to send so much money to this person, right? Or now, back in MBA program, they introduced us to the concept of alignment, that management should be aligned with shareholders. And we're not going to get into ESG, which is environment, social, and governance kind of principles here. We're just going with pure finance 101, where you want your company to return shareholder value. No politics here. So what you really want is top management who are making decisions of how to deploy the capital of this black box called a company, that you want to make sure that they look like shareholders. And by definition, being able to be paid out $1 trillion through company stock, that would be very shareholder-esque, right? He is a shareholder. So I agree with that. Now, it depends on how much risk you want to take. It sounds like they are pushing him to do the robot thing and to do whatever means necessary to return that the value to have him merit this payout. So it depends on if your shareholders are willing to accept that risk. Now, so far in Elon Musk's Tesla life, things have kind of played out for him. He's in a lull right now, but remember, 10 years ago, things were not looking quite this rosy. And so he has been able to pull, the magic, the rabbit out of the hat so far. He's not my cup of tea. He's, just as a person, he's not focused solely on Tesla. And that's my biggest issue here. He has other companies. They're trying to draw all of his attention there. I'm thinking just the human being that he is, he's not going to ever solely put all his efforts into one thing ever. But, do what you will.
Can we all just
Kristen, go ahead.
Yeah, I was going to say, take a moment to appreciate that we are not board members of Tesla, because what a hard year they have had to try to figure out how do you get your CEO focused on the company, and trying to come up with this $1 trillion, basically carrot on a stick to say, we need you are a visionary. We need you focused here. They need longevity, really. And that's what this plan is aiming to do, is to really get him focused over the next decade in these initiatives and these products. So while it is mind-boggling, just the amount of, the benefit package, I do understand what they're trying to do, which is like, this is just not a CEO you can replace. And so what do we do to get him to really to dial into what is going on here at the company?
I look at the man as modern day Thomas Edison. And Thomas Edison, just to tell you, wasn't always successful. Insisted that direct current was the way to power light bulbs. And clearly he was wrong. And Elon Musk, the modern day, will have things that he certainly thinks is right, which won't be. And I don't know what they are because both men are smarter than I ever thought I would be. And as Kristen points out, the carrot on the stick is wonderful. I doubt that he'll get that much money when it's all said and done, because I don't think he's capable of being that focused. Just like Thomas Edison was not capable of being focused on one thing. I mean, he did motion pictures. I mean, along with electricity and many other things. So, and Musk is in the computer world, the technology world, I think is a better way to say it, is all over the place. And some of these, I mean, the Starlink thing is amazing.
Michael, any comments?
I'd have given him 2 trillion. That's just me.
Okay. Well, before I end it here,
Do we hear 3?
yeah, exactly. I also, since you have such knowledge of electricity there, Frank, will you come to my house and take care of a few things?
No.
No.
I can handle as long as it doesn't include putting wires into that box that has all those circuit breakers in it. I won't get near that thing.
Yeah, I don't blame you. All right, thanks for our conversation today. We'll continue our look at investing in the economy in future editions. And since you're watching or listening to this podcast, I ask that you hit the like or the subscribe button on whatever platform you happen to be using. But for right now, thanks for joining us, and we'll see you again in about 2 weeks for the next edition of The Bull, the Bear, and You.